Jones. I am a director with the Texas Tax Credit Division of Swanson Reed. Welcome to our webinar today. Swanson Reed is a global R&D tax credit consulting firm. We assist companies with qualifying and accessing the financial benefits of federal and state-based research and development tax incentives. During the next 50 minutes, we will provide an overview of the R&D tax credit. The knowledge level is basic, and our field of study today is taxation. We will be reviewing the R&D tax credit legislation and discuss the types of research activities that qualify for the credit and the qualified expenses used to calculate the financial benefit. Then we'll discuss the types of supporting documentation we use to substantiate an R&D tax credit claim. We will allow time at the end for a Q&A session. By the way, there is a Q&A box in your top right-hand corner to submit questions, or you may simply click on the Ask a Question link at the top of your screen, and we will answer questions at the end of the webinar. Our learning objectives today is to, upon completion of this course, you will have an overall understanding of the R&D tax credit and be able to identify qualifying research activities and expenses. You'll be able to define the IRS four-part test, calculate an estimated R&D credit, get a better understanding of the PATH Act of 2015 and how it affects certain types of businesses, and you will be able to determine the type of documentation required to substantiate an R&D claim. Thank you again for signing up to our webinar on the R&D tax credit. We will be asking yes and no questions throughout the webinar. Please take time during the presentation to answer these questions on the participation form at the following link. Please fill in your contact information, questions 1 through 5, and the course evaluation at the end. We would love your honest feedback. Now remember, this form must be submitted within 20 minutes of the webinar ending, and we do appreciate your time and effort. Now I would like to introduce our tax director, Mike Flesher. Mike oversees all R&D tax credit claims within our Southern U.S. region. Mike will explain how claiming qualified R&D expenses can reduce federal and state tax obligations. Mike, I'm going to turn the floor over to you now to educate us on how companies and tax preparers can utilize this legislation for long-term tax planning strategies.
Okay, thank you, Sherry, and good morning, everyone. Okay, as Sherry mentioned, this presentation is a basic overview of the R&D credit as it applies in the United States, and in those cases where we get down to some state claims, there's rules that apply to those states also, where the credit is limited within the confines of those states, because as we'll see as we go on, the intent of the R&D credit is to stimulate economic activity. And so one state is not going to pay a credit, obviously, to benefit another state. As in the case of the United States, is not going to allow a tax benefit to stimulate economic activity in China or India. So those are the intents and purposes of the R&D credits. Two key pieces of legislation that impacted this over its history began in 1981 as part of the Economic Recovery Act when President Reagan was the president. And then the second key piece of information is what's commonly known as the PATH Act, which stands for Protecting Americans from Tax Hikes Act of 2015. It was passed in December of 2015. PATH Act is a large consortium of tax-related issues, and they extend to some very strange areas like the tax implications of grafting fruit trees, tax implications of steam-powered cars, but and also, and another strange one is the tax deductibility of IRS agents using their personal telephones for business purposes. So there's lots of things in the PATH Act, but we're going to focus on just one part of it. Is Section 121. That is the part that speaks specifically to research and development. That is broken into 4 subparagraphs, A, B, C, and D. Part A is about the permanency of the law. Part B is about the alternative minimum tax. We're going to talk about that in the next several slides. And subparagraph C is about payroll taxes, allowances that we have there, and we'll talk about that more as we go further into the presentation. And then subparagraph D is about the effective date, and we'll clarify that as we go a little bit further. Okay, the impact of R&D tax credits, it is significant. If you're familiar with the difference in a deduction and a credit, you know that a credit is worth far more than what a deduction is. Deductions are pre-tax tables, and when you go into, say you got the same amount of expense, say $10,000 in deductions, but when you go into the tax tables and come out the other end, you'll realize about a 15% impact, positive impact to your bottom line, as opposed to a credit. They are post-tax tables. They are not filtered through the tax tables, and you get a dollar for dollar benefit to your bottom line when you use a credit. So in other words, if you had a $10,000 deduction, you would realize 1.5 was $1,500 impact to your bottom line, as opposed if it was a $10,000 credit, you would realize a $10,000 benefit. So there's an enormous difference there. The credit rewards taxpayers for engaging in qualified research activities, providing a credit equal to a percentage of the eligible expenses, and I'll add some clarification to that later. Okay, who's eligible? There's a wide range of people that are eligible. Everyone's eligible for every industry if it satisfies what's called a 4-part test, which we'll address a little later. As you can see with this graph, the largest beneficiary of the R&D credit legislation is a manufacturing industry, but there are other industries that do benefit. As you can look down that bullet list on the right side of this slide, you'll see all the different industries that benefit. So regardless of what you're doing, chances are you fit in one of those niches at one place or the other. We have a first question here to be answered as part of this presentation, and your answer space is to the right of your screen. And question 1 is, are all industries able to access the R&D tax credits? And that's answered on the slide you're looking at. Give you a few seconds to think about it, although it shouldn't take very long. Obviously, yes, all industries can access or take advantage of the R&D tax credits. Okay, the IRS has a 4-part test. I mentioned that a while ago. This is a test that's used to identify what is research and development activities. And all 4 of these components has to be affirmatively addressed. You have to satisfy all these requirements to be able to claim an activity as a research and development activity. First of all, the most important one is that the activity has to be technological in nature, which focuses on those sciences that are listed on the slide, whether it's chemistry, engineering, mathematics, computer science, something in those areas. This is a technologically driven tax incentive. Second point is there has to be a process of experimentation. You would not be conducting research and development unless there was a problem that you had to experiment to try to solve. That is going to involve trial and error. Trial and error involves expenses, many of which will be futile. The trial and error will not be successful, and that money will be lost. Well, those expenses are allowable for the R&D credit purposes, but you have to be able to show or make a case for or answer affirmatively that you had to do experimenting, building prototypes and models to arrive at a satisfactory solution. There has to be technical uncertainty. In other words, you really don't know the answer when you're getting started, but you're searching for it. You're trying to find the best way to do it, the way to make a process or a system more efficient. So you begin with a point of uncertainty and hopefully end up with a certain solution. And then there has to be a permitted purpose, which is that you have an objective. You know where you're going to, whether it's to improve your functionality, your performance. In other words, make an assembly line in a factory run more efficiently. Like you can change the routing of the input of your raw materials in a certain way and maybe add a new machine that combines two functions into one, make it more efficient. That's a good purpose, a good objective. It has to be reliable. In other words, once you put it in place, you can depend upon it. And then it's all driven by cost reduction. So that is the four-part test. R&D does not have to be successful. I mentioned that briefly on the previous slide. Trial and error prototypes are all going to cost money, and many of them are going to fail. And while those are lost expenses, they can be claimed on R&D, and you can recover a large portion of that. Okay, qualifying research expenses, QREs. They are the operating expenses that a taxpayer incurs, and they form the basis of the R&D credit, and they have to be substantiated and documented. We have a brief slide at the end of the presentation on documentation, and what it says in 25 words or less is if you can't document it, don't claim it. Because if you get audited, an IRS agent will want to see an invoice, a payroll register, or some basis of the claim that you're using, or it will be disallowed, which is the same thing. It'll be backed out, which will reduce the credit. And if a pattern's formed, you could have something more serious. There was a pattern of padding the expenses. Okay, the QREs, qualifying research expenses, break into three major categories: payroll, supplies, and contracted research services. And let's go into each one of those to add a little more clarification. Payroll typically is the largest QRE. It drives the train onto how successful the credit is going to be, or how high it's going to be, how lucrative it's going to be for you. And the key points to take away on payroll is the categories of people that whose payroll can be claimed in this expense accumulation going through. It has to be people that are engaged in the actual research, like the chemist who is actually working with mixing chemicals to come up with a better solution or an ingredient for, say, food products, to come up with a better way of doing it, or the engineer who is changing angles on something to make it more efficient. The people who are actually putting their hands on the product, doing the actual research. Could also count the payroll of people who directly supervise the people who are doing the research. That's first line supervisors. Cannot be a division manager or the plant CEO, because chances are they don't do direct supervising. And then also people who directly support the qualified research, be say a laboratory that is validating results as you go along. But it could not be someone like a janitor who just cleans up the room at the end of the day, because that is an indirect administrative type support function, and it does not add to the actual research and development. So the focus is on either directly involved in the research, directly supervising, or directly supporting it. Administrative and indirect support does not qualify, which leads right into question number 2. And again, you can answer this to the right of your screen. Is supporting indirect qualified a QRE? I'll give you a few seconds to think about that. And you should have picked no, it's not. False. Okay, supplies break in 2 categories, and to explain this a little simpler, we're going to break them out, take them one at a time. Supplies can fall into the category of being expendable items or consumable items. Same thing, we'll deal with them in the same way. These are items that are totally consumed in the research and development process. There's nothing left when you get done. Examples are chemicals, raw materials, circuitry, different types of wiring that's got different resistance levels you may want to put into the project. They're totally consumed in the process. When you get through the project, nothing's left. So they're totally. You can also count in the supply category durable equipment, but you have to focus on cash outlays during the calendar or fiscal year, the financial operating period for which you're filing the tax claim. This is for equipment. I'll clarify that in just a few seconds here. The equipment has to be specific to the R&D. Preferably it's scrapped after the project and there's no resale value. And the intent there is that you don't buy a big piece of equipment, use it on R&D for a little while, and then spin it off to be used somewhere else in the factory, because therefore that total cost of that piece of equipment would really not be applicable, all of it, to R&D. You should avoid claiming general use, general purpose equipment such as forklift, facility repairs, computers, trucks, things of that nature. Computers are typically a red flag item. If you went out and bought 10 new computers and you start out saying, oh, these are going to be used on R&D, so I want to claim the whole cost. And then a year or two later, you pass those computers off to your administrative staff and they use them for other purposes. So that's why we cannot use assets that are being used elsewhere, claim them towards an R&D credit, because the entire cost of that item is not devoted to research and development. Okay, I mentioned the cash expended part, and this is what keeps us honest. This is what keeps us from deviating from what we should be doing. If you just count the cash that expended on that equipment during the year that you're filing the tax, that you're filing the research and development claim, you'll generally keep out of trouble. Payments in full if in fact you paid for the equipment totally. I mean, paid 100% of the cost of equipment in that year. And as long as it's an R&D piece of equipment, satisfies requirements discussed in the first two bullets. You can count a down payment, or if you're paying it out on credit, you can count the from an amortization schedule. But cash outlays is the focus that you have to keep. Do not count the full cost of the value of the piece of equipment if you're going to use it for other purposes. The durable equipment falls into the same philosophy as the consumable supplies that we talked about on the previous slide, where again, they are used, they are costed out completely within the year. And as long as you stay within the year and just count the portion of the cost applicable to that year, you'll stay out of trouble. Okay, contractor research expenses is be like a lab outside your company or your operation that you ask them to do some sort of validation or testing to see if you're getting the results you're doing. I say a laboratory, it could be any outside agency that you contract with. You get to cap those expenses. They have to be capped at 65%. So if you paid ABC lab company to test some of your results, or someone that tests the a metal that you've modified in some way, and they charge you $10,000, you can charge $6,500 of that to the R&D project. Expenses have to be for bona fide research and not routine services using existing technology. So if you Bob's Electric Company came down and did some rewiring in your building, that is really not R&D. Supporting documentation, invoices, and 1099s. Do a 1099, it has to be at least a $600 charge within that year. Okay, exclusion. Certain things do not count as research and development. I won't read this list to you. You can read it just as well as I can. Call your attention to the first one that makes the point that research and development ends as soon as your prototypes are built. You're happy, you're satisfied with the model and the process that you've got in place, and you begin normal production. The moment you begin normal production, research and development ends. So you can't go any further than that. Go down, usually I like to call your attention to that fifth bullet. It's kind of a replay of something mentioned earlier. Foreign research conducted outside the United States does not count. And we've run into that in several cases where people will contract either with people in China or in India to do some research. Does not count. Anything spent over there does not count. Because again, the purpose of the law is to stimulate economic activity within the United States, not in India. Fairly self-obvious. Okay, limitations. There's no upper and lower limits on QREs. You can have anything from a $10 million credit to a $1 credit. No limitations on either end. There is a point of economic feasibility on the low end of the spectrum, though, that it may not be cost advantageous to file for an R&D credit. Obviously, if your credit is so small, let's say $500, but it took you $3,000 to collect the information to claim that credit, it's not worthwhile. So be sensitive to that. Okay, amended returns. You can claim R&D credits through the amendment process. And the amendment process, standard procedures for that, normal standard rules for amending returns apply. Generally speaking, you can amend a return up to 3 years back. Now, you get into some of the finer details of it. If you file a timely filed return, which is the initial due date, then the 3-year mark is the initial due date. However, if you requested an extension, then the 3-year mark is the date that the return was actually. So fine little nuances there, but generally speaking, returns can be amended up to 3 years back. So you could go back and claim 3 years of R&D credits from the past. Just a word of caution, again, this is just normal tax. This is not R&D. But when a return is amended, that opens that year to full scrutiny by the IRS. So if you got that you want to let just keep sleeping, it's best not to amend a return. There's something you don't want drug out in the sunlight where the IRS gets a second chance to look at it. It's best not to amend previous years. If you don't have that situation or that circumstance in your life, an opportunity to clean up on 3 years R&D credits is by amending the previous 3 years. Credits can be carried forward 20 years and back 1 year. So even though you can't use an R&D credit in the current year, say you don't have a tax, say that you're a new company and you're still running in the red, you have no incomes, you have no taxes, you can go ahead and get that R&D credit, and it's good for 20 years. If you've got confidence that at some point in the next few years you will have taxes, it could be deferred. A carry forward credit is good as cash. It's the same thing. It's just a matter of when you get to use it. Okay, college, working with universities and colleges generates an additional credit. Is technically, if you look at the form 6765 is what is used on federal returns to calculate R&D credits. It is actually a second credit. It's calculated differently than what the big three, the payroll, supplies, and contractor services we mentioned earlier, is calculated in a different manner from those. You have to determine like a base period, and that gets multiplied times 20% in the case of the alternative method, which will make some distinctions there later or clarifications there later. There's a different way of arriving at it, and then that is added to the credit that's calculated for the big three. Effectively, it generates like 2 credits, and they get totaled up to give you your total credit. But the way you calculate the university is more advantageous than the way the other 3 expenses are calculated for credit purposes. And so if you've worked with a college, it is a good thing. If you are filing state returns, most state returns, or I say all state returns, reward that too. And Texas is very lucrative because if you work with a university, you get a preferential rate. Texas has actually got 2 pairs of rates based on a number of things, but they're grouped like in pairs, and you got 2 of those pairs. You got 4 different rates that are used to calculate Texas credits, and either one of them, if you had university expenses, you get the preferential rate in both of those 2 categories as they apply to you. And the kicker on it is that preferential rate applies not just to the college expenses, but to all of your expenses. So it's very advantageous in Texas, at least, to work with a university. I go out and work with a university, make a little $1,000 contract with them if you've got many other expenses to count too, because that $1,000 expense with a college will get a better rate that will apply to all of your QREs. And so it's got a big multiplier effect in the state of Texas. And so if you're not doing it, I think it'd be cost advantageous to just go make the smallest of contracts with a college to get that beneficial rate in Texas. Speaking of Texas, you get a choice on how you claim the R&D credit there. You can either apply it as a credit against your franchise taxes or an exemption from the sales and use tax. And this is where the taxpayer gets to make a decision. Where would it help me the most? If you've got high franchise taxes, you'll probably want to pick that first. If you're, say, expanding and buying lots of equipment, you're going to have lots of sales and use taxes, put your credit on the sales and use taxes, and that will benefit you more. So you have to make a choice between the two as which way you're going. Best thing about filing a state credit, and I say this with all states, and Texas included, is that the tax workup, the information that's been gathered for the federal return, applies in an equal manner to the state return. So you don't have to go back and dig up payroll again. You don't have to go back and dig up supplies again. You can take the same data, put it on both claims, and benefit in both cases. It's like killing two birds with one stone, or getting two tax workups for the price of one. It's a good deal. Another thing about Texas, if you elect the tax option, again, that's an option. You can choose that or exemption from sales and use tax. It's capped at half of what the tax that is that year. So if you got a $5,000 franchise tax, you can only claim up to $2,500 exemption through the R&D credit. But have no fear, the rest of it simply carries forward. It is not lost. You can use it in a future year, and Texas credits accumulate very quickly. So you could easily, in just a few years, build up enough credits that will suffice you for about twice that number of years. That's how lucrative they are. Okay, let's go through some simple calculations on your credit, and we'll keep this real simple. I'm going to use small numbers and round numbers, so it will not be difficult. The first thing to do in calculating your credit is to estimate your QRE. That's those three big factors that we talked about earlier: your payroll, your supplies, and the contractor research expenses that you have. This is what forms the base of your calculations. If you can get this part right, the rest of it is so easy. And okay, we got another question here that we got to answer. And let's see how hard this one is. Can R&D tax credits be carried forward 20 years? I think you'd have to go back one or two slides to know the answer to that one. 3 slides, something like that. I'll give you a few seconds to think about it. The answer I got was yes, they can be carried forward for 20 years. So if you got that answer, you got it right. Okay, moving on to the calculation method. There's 2 ways to calculate credits. What's called the regular method, and then there's the alternative simplified credit method. And Swanson Reed encourages us to use the alternative simplified credit method, and we're going to talk to that in these examples. Now, if we want to go the other way, that can be done separately. It have to be done under a separate forum, because I don't have slides worked up on that. The regular method is more complicated too, but we're going to use the alternative simplified credit method, which is Part B, or Section B, in the form of 6765. If you want to call one of those up on the internet and check these numbers out and see where they go to, you're certainly welcome to do that. Let's assume that you've calculated your total QRE, that's qualifying research expenses, the 3 big categories you talked about at the beginning of the presentation. So they come up to $10,000. For the first 3 years that you're filing claims, you use a rate of 6%. You multiply that 6% times your total QREs, and you get a gross credit of $600. Now, there is a thing that applies to the regular method and the alternative simplified credit method both. It's called the 280C election. And just put that on the back of your memory for right now, and we'll talk about it in more detail later. For the alternative simplified credit method, it's in the form 6765 on line 34, and we're going to give some specific instruction on that here as we move forward. But we're going to count 100% of that credit, so your total net credit benefit is $600 in this example. Now, again, the point, the takeaway on this is that this is the method used for years 1, 2, and 3 that you're filing for R&D credit, and this rule would apply equally if you're doing an amended return. So you're amended back from 2013 forwards for years 2013, 14, and 15. That's 3 years, and on each one of them, you use this method here. Real simple, nothing hard about this. Now, when you hit year 4, it gets a little more difficult, but not that much more difficult. This is how it's done in year forward, and as you move on forward after that, years 5, 6, and 7. Once you have those 3 years done and move into year 4, this is how you calculate the credit for the 4th year. Let's assume that the current year is 2014. So the 3 previous years, if you look in the upper left corner of this slide, is 2011, 12, and 13. And let's say your QRE in those 3 years, to keep the numbers small and simple and round, it's 5,000, 10,000, and 15,000. You total up all those QREs from those previous 3 years. In this example, you get $30,000. Take the $30,000, and I'm looking at line 2 now, this slide, or bullet number 2. You take that 30,000, you divide by 6. Now, what that is, they don't show this on 6765 now, but this is how they arrive at it. The IRS wants you to take an average of those three numbers. So you got three numbers, so you divide it by 3 to get an average. And then once you divide that by 2, well, 3 times 2 is 6. So instead of dividing by 3 and dividing by 2, you just divide by 6, because 3 times 2 is 6. So you take that 30,000 and you divide it by 6, and you get $5,000. That's on line 2 of this presentation. That forms your what's called your base amount. Then in the current year, moving on to bullet 3 or line number 3, let's say it's your current year QRE are $20,000. So from that 20,000, you subtract your base amount and you get 15,000 left over. And forward, take the 15,000, which is your current year QRE net of the base amount, multiply it times 14%, and you get $2,100 as your gross credit. Line 5 is simply a repetition of the issues circling around the 280C election. And again, we're putting that on hold for a few more slides. And let's say that you elect no, and you're going to take 100% of that credit, would be the $2,100. So what you're going to, the walk away, take away that you're going to get in this example is a $2,100 credit. Now, many times you will hear that, oh, when you move to the 4th year, instead of a 6% rate, you're going to a 14% rate. And that sounds great and wonderful. But the IRS has changed the rules on the way that the calculation is done. For the first 3 years, when you're getting the 6%, it's just total QREs times 6%. It's undiluted. But they changed the rules from year 4 going forward, where you have to net out a base amount out of your current year QREs. So you're starting out with a lower base than you did in the first 3 years. And yeah, they do multiply that, what's left over, the residuals left over, by 14%, but the base has been reduced. So the IRS does some changing of the rules as you move into year 4. It is also possible in this scenario to get upside down. If your base year is greater than your current year expenses, you get into negative numbers, and the credit goes out to 0. You don't get anything. But if you don't have, like, the way that what drives that is you have to have increasing credits. So if you had some real high credits in those earlier years, and so it gives you an average of those 3 years, or the base period as you calculate is a high number, and then you come in the 4th year with a low level of QREs, then your current year is going to be less than your base period, and you'll be negative, and you're going to ground out at 0. So that's some of the nuances you'll see as we move into this. But it's important not to be led when you hear someone say, oh, you moved from 6% to 14%, but the rest of the story that doesn't get told is, yeah, but the IRS changes the rules on you for how that gets calculated. In most cases, I will say that it's usually a good thing. Not too many people do go upside down, but it has happened a few times. Okay, 280C election. Let's get into this. This is the single most important decision to be made in filing for R&D credits. So if you haven't been paying attention so far, this is the part you need to wake up and pay attention to, because this has more impact on your bottom line than any other decisions you'll make. The 280C election is a choice that you get as a taxpayer. And as you'll see in the next few slides, I'll show you some pictures of where it appears on the Form 6765. Or the situation the IRS is left with is that we cannot count expenses and deduction, or excuse me, expenses cannot be counted for deductions and credits both. That'd be double dipping. So there has to be a way to sort it out so that those expenses apply to either the deductions or either to the credits, but you can't have both. And you'll see a little bit, but that's what drives the train. You'll see a little bit clearer here on this next slide. This is the 6765. If you're using the regular method, which is section A, you'll see down in line 17, where you get a choice. Are you electing to reduce the credit under 280C? And you'll see you got a choice of yes or no. That's in section A. Now, if you move to section B, which is the second half of page 1, but then going over to page 2, and you'll see there at section B, going down to line 34, and you see you get the same choice again. You get a choice to elect yes or no. Okay, now let's get into what yes or no means. If you elect yes, you're telling the IRS that you want those duplicated expenses. In other words, let's say that Willie Smith has got a salary of $100,000, and say that Willie worked on R&D, so 100% of his paycheck. That $100,000 is in the deductions, is in the expense with the ordinary business expenses forms of deductions, but he's also in the data that we collected for research and development. Well, we can't have it in both ways. So if we elect yes, what we're doing is we're telling the IRS to deduct out those expenses out of your credits. Now, the IRS has selected an arbitrary rate of 35%. That is the standard federal tax rate for corporations. So they selected that, and that may be changed under the incoming administration, but right now it's 35%. And the inverse of 35% is 65%. So they tell you to multiply your R&D credit times 65%, and that eliminates those expenses out of the credit, and you just leave them right over there in your deduction field, an ordinary business expense. And so they're counted as a deduction, but they've been backed out of credit, so you don't have duplication, and the IRS is perfectly happy. On the other hand, if you pick no, that's where you're saying that you don't want those expenses to come out of your credit calculations. Instead, you want them to come out of your deductions. And so what happens is you leave them in your credit calculation at a full 100%. You don't reduce your credit calculation at all. Leave it at 100%. Whatever your gross was, that's also the net amount. But you have to take it out of your ordinary business expenses. And that's done through a work paper and nearly every tax return, where you'll take the amount of, say, in the example I use Willie Smith or whatever his name was, $100,000, you will show a negative $100,000 in calculating your, it pulls them down. When you pull the deductions down, you get a slight rise in your taxable income, which increases the tax there, but that is more than offset several times over when the credit is brought in. So that adjustment has to be made if you pick no. But in nearly all cases, it's advantageous to the taxpayer. And why is that? Because you get to count Willie Smith's $100,000 salary as a credit, and you get 100% benefit from that. If you left it over and count in the ordinary business expense and count as a deduction, your bottom line will be improved by like 15% of, whatever that is, 100,000 times one, or 15%. And it's a difference in daylight dark. You come out far better to count it as a credit. So Swanson Reed recommends when you get to the 280C election, whether you're using your regular method or the alternative simplified credit method, line 17 or line 34 as it applies, that you select no, keep all those expenses and credits, maximize, get the most bang for the buck, maximize your credits, and suffer a slight loss over there on the deduction side. Complicated, but again, based on how you do this, you could lose 35% of your credits. Okay, PATH Act of 2015. Okay, I mentioned this at the beginning of the presentation, and I mentioned the sections it involves. It's section 121 of the PATH Act. It's the R&D piece only. 4 subparagraphs, A, B, C, and D. And we're going to talk about the ones that are important. First one, this first bullet here is the most important. It makes the R&D credit permanent. Now that's subparagraph A of section 121 within the PATH Act. Very important because up until 2015, the PATH Act was contentious from year to year. People didn't know what to plan, or excuse me, the R&D credit was contentious from year to year. People didn't know if it was going to count or if it wasn't going to count. They didn't know whether to plan for it or not plan for it. Well, now we know that it is permanent. It's going to be there, so people should be planning for it if, in fact, they intend to pursue it. The second bullet gives describes certain category of people, less than $5 million grocery receipts, blah, blah, blah. You can read it on the slide. But they get to offset, this group of people gets to offset their payroll taxes with R&D credits, and that's subparagraph C of section 121. We'll talk about that in more detail because that gets a little more involved here on the next several slides. And then there's another category of taxpayers, as you can read on the slide, that third bullet, all allows taxpayers $50 million in average grocery receipts, blah, blah, blah. They get to offset their R&D credits against the alternative minimum tax. And we got an additional comment we'll make on that. But first of all, question number 4. Is the R&D tax credit permanent? To clarify that a little bit, we might say, is it permanent right now? I'll give you a few seconds to, I'll take the test too. Let's see. And I got down, my answer is yes. Yes, it is. Right now, it is permanent. So if you intend to file the R&D credit, you can plan for it. Okay, only comment we're going to make on AMT. AMT, for a certain category of taxpayers. And what it does is it kicks the slats out from under the credits or the claim, the taxes. It can be filed by removing standard deductions, all the deductions, the legal exemptions and deductions that most taxpayers enjoy. It takes all those away so that everybody has to pay some taxes. In other words, it's two sets of rules, and this is a set of rules that apply to people in this other category. The R&D credit stand now that it can apply towards AMT. So the R&D credit is one of the few shelters against the alternative minimum tax. So if you happen to be one of those people who's typically affected by AMT, this is the way to get some relief. You can call it a shelter, a safe harbor, whatever you want to call it. But R&D is a good benefit to have in this case. Now let's get into the payroll tax offset. This is quite more involved, and more importantly, it helps the little guy, companies that have just started and probably don't have a cash flow, and they may be running in the red. They don't have any taxes to pay, and yet they've got R&D, and they can either calculate the R&D and just let it sit there and carry forward for 20 years on the hope that they'll get to use it at some point in the next few years, or you can use it now by applying against the employer portion. We'll have a picture of the Form 941 here as we go forward. But FICA taxes, they're a combination of tax on for Social Security and Medicare. The Social Security piece accrues at, I think, 6.2% of your gross wages. The Medicare piece is 1.45% of your gross wages. And those rates apply to the employee portion of their gross payroll as well as the employer portion. The same rates, same gross side that they're applied against. This offset applies against the employer portion. Even though the numbers same, employer numbers are the same, you can apply this credit against the employer portion only. There is a cap on it at $250,000, $250,000 per year for 5 years. And it's effective. The way the law reads, it says it's effective. This is Section D of the law, Section 121. It says effective for tax years beginning 31st of 2015. Well, guess what? You know, the first beginning date then would be January 1st of 2016. Now, nobody in this audience has filed their tax returns yet for 2016. Nobody had a year beginning before January 1st of 2016. So this is something that is coming before our eyes right now in 2016. People start filing their tax returns. So it's the beginning date of the tax year, which is January 1st of 2016. Or if you want to be technical, the law says beginning the first, the tax year is beginning after December 31st of 2015. And the catch to this, or not a catch, but one of the key points to be made on it is that the payroll tax recovery can only begin after the tax return, the main tax return, has been filed. If you're one of those taxpayers who procrastinates, requests an extension, and may not file until August or September or somewhere out there, you can't begin putting these credits against your payroll taxes until after you file that main return. Now, if you want to be an eager beaver and get in there and get your returns filed by April 15th, because that's the new filing date for C Corps, and I won't get into that can of worms, but the filing dates have changed. You should be aware of that. And if you get do what's called a timely file return, file them by your initial due date, then you can begin claiming that credit against the employer portion of payroll taxes the very next payroll period. And payroll periods for tax purposes are broken out into quarters. And so the first quarter that you should be available to do this, if you're real quick on getting your return in, would be the second quarter of 2017. So it behooves you to get your return in early. Now let's go through. I got a couple of slides, scenarios shown here, but what I want to do when we get done with this, I want to walk you through where the numbers carry over, because as a taxpayer, you need to be aware of, is your software current payroll tax. If it's not, if it doesn't include the updates and stuff, then you won't be able to do this. And I want to point that out to you so that you won't come up short. Okay, how does this payroll tax work? Say that you've got two startup companies that still don't have any income. Both of them, company A, company B, got zero income. Say that company A had payroll taxes. Again, that's employer portion only, $45,000, and company B, same amount, $45,000. Company A had calculated $20,000 in R&D credits. Now let's just stay in the company A column and work down through that. Okay, so they got $20,000 in credits, so they can immediately use $20,000 of that to get rid of that many taxes. They don't have to pay that many taxes, but they've lost it all right there. It's all gone. I mean, they've used it all up, so they don't have anything to carry forward, and they as credits and they had taxes, so they still have to absorb $25,000 worth of taxes. On the other hand, move over to the company B column, and we'll work through that about the third line down. So they were the eager beavers that they really got in there and calculated $65,000 in R&D credits. Their tax bill was $45,000. As you can see, they got enough credits to offset that entire tax bill. They can immediately use $45,000 of it, and plus they got $20,000 left over that they can carry forward to the future, and they didn't have to absorb any tax in that year. So in a nutshell, that's how it works. Now, how this works is I want to walk you from one form to the mentioned earlier is the federal tax form for claiming R&D credits. If you print off a 2015 version of that form and a 2016 version of that form and lay them down side by side, you'll see the main difference is that the 2016 version, the one that will be used when filing taxes this year for the last tax period, in other words, 2016, has added a Section D. You will not see that on the 2015 version of that form. Go to line 42, and you'll see the enter the portion of your gross credit as a payroll tax credit, and it's capped at that $250,000 that we've already mentioned. So if I was a small business owner and I anticipated my payroll taxes for the coming year to be $5,000, that'd be what, $1,250 per quarter, I would put $5,000 in that line and say that my total credit was $15,000. So I'd still have $10,000 left over to use on current year income taxes or to carry forward to future periods when I thought I would have a tax. But let's say that you put $5,000 in line 42. You're saying I want to earmark that much of my credit for payroll taxes. Now remember that line 42, $5,000, and you see where this ties in with the payroll tax form as we move forward. I got these in sequence. This is what your payroll tax form looks like now. It's a form 941. Should be familiar with it. This is the one where you file for them a year. They're quarterly, and this is where the IRS collects Social Security taxes, 6.2% of gross wages, like I mentioned earlier, as well as your Medicare taxes is 1.45% of your gross wages. On this form, they collect the employee-employer portions both, and this is what it looks like now. But this form has been changed for 2017. This is a draft copy. I can't recall where I've got it, but I got it from credible source. But this is what the draft 941 looks like now. You see that the IRS is in, and they'll start using this in the second quarter of 2017. See that line 11 down there? Qualified small business payroll tax credit for research activities. Now, what number goes in there? Let's go back up 2 or 3 slides. See, when you did your 67, 65, if you do a timely filed tax return, get your tax return in early. And I said on line 42, you'll put in $5,000 because you're allocating $1,250 per quarter. And so you want $1,250 in this current quarter on this example working. So you see line 42, you put that in there, go back here, and in line 11, you'll put your $1,250 in there. Now you still got the rest of that $5,000 that you set aside to use in subsequent quarters, but that's where it would go, and that will offset the employer portion taxes. Okay, documentation. Only mentioned this a few times earlier in the presentation. You got to have good documents. Your payroll, if you're a calendar year filer, W-2s are best to use on that. If you're a fiscal year filer, just be aware that it's not hard at all for the IRS to make sure your numbers are right. W-2s or a calendar year document. But the IRS could easily go back. Let's just say you are a fiscal year filer with a June 30th cutoff, and they could pull 6 months out of the end of one of your fiscal periods, add it to the first 6 months of your next fiscal period, and both of those are within the same calendar year, and they total those up. That should equal to what's on your W-2. So just rest you straight for what you pay out. In other words, the total of those 2 6-month periods out of different fiscal years will be the same as what should be on a calendar year W-2. But payroll, W-2s are your best document, or something that's transferable or allowable within a W-2. You can have interviews, work schedules. If you got something like, say, Mr. Smith or Willie Smith, we'll use him again. Say he spends the mornings working on R&D and the afternoons working on other jobs of some kind. Have a memorandum where you counseled Willie Smith on whatever, October 1st of 2016, and you told him that's what you want his work schedule to be. Then you could apply 50% of his total salary to R&D, and you've got that letter to show the IRS. IRS is really not into like, oh, you got to have this signed by notary public, you got to have 3 witnesses and have it videotaped. They're not into that. If you've made a reasonable and prudent due diligence that you're documenting what you do, that will count with the IRS. I just want to see that your brain was turning on this, and that you've made an effort to report this as fairly and accurately as possible. So memorandums work. If you've got work schedules, we got one client in Houston that has got some kind of a fantastic software program that actually allocates hours for when their employees worked on different projects. Some of them are R&D related, others are not. And but it's just a matter of just going through there, identifying what the R&D ones are, totaling up the hours, and do a little percent to total and come out okay. Willie Smith worked 60% of his time on R&D in this particular year. If you've got something exotic like that, that's good. But if not, a memorandum, you don't have to sit down and do memorandums before you file, but just realize that's a good backup to have in the event you get audited. And of course, you get a phone call from the IRS, says we're going to come visit you today, or they don't even do you the courtesy of calling. They just knock on your door at 8 o'clock in the morning. You might get somebody started on those memorandums real quick, but just have some logical basis on which you're allocating to R&D. Okay, supplies, best documentation, invoices, general ledger accounts, and contractor services, invoices, 1099s are good. Just one other point that generally relates to documentation as far as collecting data. You should have a real good filing system. You should have, talking about paper files, which I guess is primarily where you put invoices. You should have a person that's got an aptitude to keep things organized doing your filing system, because if the IRS says, okay, where's your receipt for this $5,000 purchase from this company, that person should be able to go right to the files, pull it out and give it to them, and you're okay. But if they ask that $5,000 receipt and the person starts scratching their head and their eyeballs start looking at the ceiling and they're really not sure, then you got a problem. So have somebody working your files that knows what they're doing. A lot of electronic files, as far as filing things electronically. It takes effort to stay organized. It does not happen by magic. You got to put time in on it and keep things organized. But even on electronic files, if you can have certain folders set up where you collect cost that apply to your R&D, that works. A financial thing, have cost centers. Perhaps as one taxpayer did this. They had a cost center. They called it research and development, and they had different GLA, general ledger accounts, assigned for the various accounts, and then they put everything in those accounts. It was right there. And so if they get audited, which incidentally they didn't, we haven't had anybody audited yet, but if they get audited, they can go right there, and here it is, Mr. Auditor, and you get a pass. IRS, like I mentioned earlier, is not looking for some signed in blood litmus test. They just want to see that you made an earnest effort to exercise due diligence, and if you can show that, you won't have any trouble in the event of an audit. Okay, I have probably talked too much, so let me turn this back over to Sherry Jones. Thank you very much.
Thank you, Mike. We are running low on time. I want to quickly walk everyone through a case study to help us better understand documentation. Quick case study. This company is a manufacturer of long life rechargeable batteries for smartphones, and they engaged in 6 product development activities during its battery production. These 6 phases, I want to quickly walk you through each phase to determine which is an eligible activity and an ineligible activity. Research of existing technological information. This phase, although it is critical to product development, it is ineligible because it does not meet the technical requirements. It is not eliminating technological uncertainty. It is simply building on a knowledge base of existing information already available in the public domain. Second phase, economic evaluation, is also ineligible as it is research that is related to management functions and there is no new technological information being gained. Design and modeling, this is a eligible phase, a very critical phase to the R&D claim. Your team is brainstorming to develop conceptual designs. You're doing feasibility studies to determine potential technical issues and how to resolve them. A design is selected, it is tested, it is evaluated, and then technical uncertainties are defined, potential solutions are developed, data is gathered, analyzed. This is a critical R&D phase. Your costs and expenses associated with design and modeling are eligible. Stage number 4, prototyping and trialing, also an eligible phase because the prototype is tested. The first working prototype is built. It's benchmarked against the finalized plan. Experiments are conducted, alternative designs investigated. And so that all expenses or most expenses during this phase will qualify. Sourcing and procurement, that is ineligible. It's related to management functions. No technological uncertainty is being overcome in this phase. Commercial production, Mike already explained that when you begin production, you have left the R&D phase. Although it's important to note that well-documented challenging production activities such as automation, scale-up issues, they may have some isolated QRA components that we should investigate further. Regarding documentation, and this brings us to our 5th and final question of the webinar today, the types of documentation that we ask for, this is a very important phase. The IRS's expectation as to what is sufficient has increased substantially. So taxpayers must document the progression of new information being discovered, technological uncertainty being revealed while performing the R&D activities that satisfy the 4-part test. Here are just a few of the types of documentation we ask for when substantiating a claim. Staff time, project emails, financial budgeting reports, engineering drawings, computer screenshots. So your 5th and final test question today, are project emails an example of supporting documentation? And if you said yes, you are absolutely right. Now, let's get to some questions very, very quickly. I have seen a number of questions come in. Well, one question, is there a maximum amount I can claim in an R&D tax credit? As Mike explained, there is no maximum for the federal and Texas state franchise credit. However, the FICA tax offset, the new tax credit for startups, that has a maximum of $250,000 in tax offset per year. And this is an important question. Last year was our first R&D tax claim. How many years must we wait to claim the additional 14%? The R&D claims for the first 3 tax years is calculated at 6%. And remember, Mike explained that's to establish a 3-year baseline. Now, in year number 4, that would be your 4th claim, all expenses over and above that 3-year historical baseline will be calculated at 14%. And as Mike shared with us, the legislation allows us to go back 3 years and amend previous returns and apply the R&D credit you missed the opportunity to claim retroactively. So you can see how quickly you can establish that 3-year baseline and begin earning the higher tax credit on your future increased expenses. And one last question right under the wire. We pay a foreign design firm for research expenses, but we pay it in US dollars. Can we claim those expenses? No, even though it's paid in US dollars, just like the W-2 employees, all contract labor must be based in the US. And I do apologize, there are so many good questions remaining to answer, but we will follow up with you individually and answer all of your questions. If you're submitting an R&D tax credit claim for the first time, we would like to offer to prepare a no-cost feasibility study to review your research and product development activities and expenses for all qualified tax years so that we can help you put a dollar amount on the financial benefit your company has already earned but you've yet to claim. So please take a moment to jot down my email, my cell phone, so that we can schedule time to meet in person or speak by phone. This initial study will help you determine what exactly the financial benefit is going to be for your company or your clients in dollars and cents. Then you and your CPA can decide if it's commercial and worth your while to take the next step in the claims process. Now, one more reminder, if you have not answered those questions during the session, please take a few minutes now to answer them and complete the course evaluation within the next 20 minutes. We truly appreciate your feedback, and we appreciate the time you spent with us today. And we will look forward to helping you identify current activities that qualify for the credit and prepare that initial R&D study at no cost so that you can decide which years, if any, make sense for you to claim the R&D tax credit for. Now remember, we're always here to help. And with that, we'll say goodbye for now.